Okay, let's go talk about the SEC because late last night, or late Wednesday night, I should say.
Ooh,
I know this is hot stuff.
this is really exciting.
This is a big deal, and if you don't agree with us,
You're the majority.
Yeah. The New York Stock Exchange's plan for a new IPO alternative has won a green light from the SEC. It's a headline. And essentially what this means, Danny, is that if you do a direct listing now, you will be, in some circumstances, allowed to sell shares at the market open price that is set through the normal price discovery mechanisms, along with other shareholders in the company. But instead of, selling a block of shares at a set price before like a normal IPO, you can just let the market decide the price, sell equity there. And so you can effectively raise money and direct list. Is that your read, Mr. Crichton?
Yeah, that's correct. In the current model, the SEC has not allowed direct listings to raise money. So that's why we've seen Spotify and a couple other companies go public, because they didn't need to raise capital on the public markets when they were going through the direct listing process. The exception recently was Palantir. This week we saw the S1. We talked about it on Tuesday or Wednesday or Thursday. I don't even know what day of the week it is. I don't even know what month it is. But given the news, Palantir was doing an S1, lost $500 million in the last cycle. And that was surprising because you can't raise capital as part of these processes, which is one reason why a lot of folks sort of interpreted their debt raise a month ago of hundreds of millions of dollars along that line. Same with Airbnb. We saw them raise a lot of debt. They've also been in discussions to do a direct listing, and I think it's something similar. So this option from the SEC approving the New York Stock Exchange's plan, we expect NASDAQ, I would imagine, to do something very similar as well.
Filed. Yep.
They filed, I think, this morning or 2 days ago. This is just going to give another cheaper way to go public. And I think, for the SEC in particular, they've made a huge priority to sort of help all these private companies that have been stuck, on the private markets find easier and faster ways to go public that are cheaper.
Yeah, and this boils back down to the Bill Gurley Spack Letter. Natasha, did you get a chance to read that? Because I thought it was a pretty interesting document.
I did. So I thought it was helpful. It kind of broke down the multiple ways to go public into 3 different doors: SPAC, traditional IPO listing, and the direct listing dynamic. But that was also pre this Wednesday night news. And in a very expected Bill Gurley fashion, it was very anti-traditional IPO. And to me, I feel like the news that broke yesterday on direct listings becoming broader is even further displacing the traditional IPO. The traditional IPO isn't as interesting anymore. But we should probably talk about that document slowly and surely.
Well, okay, but let's talk about what's changed, because Airbnb, Asana, Palantir, right? Effectively, they were either going to direct list or are direct listing. They raised money pre S1, and so they essentially raised private capital, usually via debt facility, maybe convertible debt, direct list, and then trade, and then figure out the debt stuff later. That was, I think, the best way to approach the markets after reading Bill Gurley's doc pre this new thing. But now I feel like if they could do it again, they would probably do things a little bit differently with this new format. Bill Gurley's memo, to your point, Natasha, was relatively positive on SPACs because of the low cost of capital and the fact that there wasn't so much of a giveaway to, as he frames it, bankers' friends, effectively. But I wonder, Danny, if you think that the SPAC option loses luster now that we have this amended direct listing option coming.
I don't know if it loses luster. I mean, again, it's a marketplace. I think it's amazing to have multiple diverse options to choose to go public. The IPO is under attack because the cost of an IPO it's skyrocketed. I mean, I think Gurley's most consistent point is to show just how much the percentage has changed of the difference between what the public values a company and what the investment bankers chose as the price of the company at the IPO. And this year was a record. It was actually, I think, 31% off from the market price. And that has steadily increased over time. The bankers are actually getting worse at pricing shares year after year after year. So why deal with people who don't know what they're doing? And I think SPACs have an interesting opportunity. One of the things that Gurley brings up, and also we're actually talking to the SPAC Insider later today. But one of the interesting things with SPAC is a lot of the folks who are raising these SPACs have huge kind of publicity machines. They're big hedge fund managers, big PE firms. And it's not just that they can put you public, they can actually get a lot of investors around the table to get excited about this new issue. So, where I disagreed a little bit with Gurley, though, was, he sort of has this view of, ultimately the market takes account of like the revenues, the actual business model of these companies. No one cares how you go public. And I still have the sense of it matters that the numbers look good the first time people get an impression of your company. I do think there's a residual impression that is laid that like if the first thing you hear about a company on the public markets is, God, what a disaster, it declined by 40%. Like, sure, over 5-10 years, people forget, but it could be years before people kind of lose that like tinge of negativity.
I kind of have a different perspective on this because, I used to think of the IPO pop as a marker of success, as, this awesome headline you get to post about a company. It's good news. But then that really, speedily went to they just mispriced and now this is all the money left on the table. And so when I think about what will matter down the road, I guess I'm more on Bill Gurley's side and like, I don't know which companies. I don't think I'll care or know which companies went which way 10 years from now. I'll just know how healthy their financials were at the moment. I don't know. I think the pop was just very confusing and it gave people a narrative that wasn't exactly helpful in understanding how a company actually should be valued.
Yeah.
Well, I think ironically, I mean, we talk about the Robinhood economy a lot on the show, but one of the challenges is that as more and more retail investors are flooding the market, the pops actually are starting to become more and more valuable. It's not the people doing fundamental analysis on Wall Street who, mostly ignore this sort of stuff and are going back to basics. It's like, Tesla's the hottest, traded stock in the country because it has a lot of publicity, because it's very exciting, because it's growing and driving and the volatility is really high. I think we have to be careful of, forgetting that the pop matters to a lot of folks who may not, focus on stock trading as much as others.
It's also really bad if your share price goes down, right? That's not great for anybody involved. In these direct listings, though, with this option to sell shares during the traditional price discovery mechanisms process, whatever, there won't be lockup periods. So if the shares start high and then they decline, fuck you. There's not going to be protections. There's no banks going to be underwriting this, stabilizing the shares. It's just going to trade. And, in a way, it feels very, very capitalistic in a positive sense to just have it go out there and float. Just, okay, let's see what happens now. Here's the company, here are the numbers, let's go forth. It feels pure to me in a way that I actually appreciate. And I feel like after being on the non-Bill Gurley side, because I listen to CEOs more than investors about IPOs, I feel vaguely radicalized in the last couple of weeks on this issue. So I'm actually joining Team Natasha on the Bill Gurley Spack IPO issue. Danny.
I think the other thing to not forget is, most of these private companies are, secondarily traded, right? There are already huge numbers of transactions happening on these companies. They have price discovery. We just don't see it in the public markets. And so to my mind, it's not so much like, none of the shares were ever traded. Now they're suddenly traded 8:30 a.m., Eastern time. It's more like, all that stuff that was happening behind the scenes is now just becoming public. It's just a transition. And I think that's where, we are in 2020. And I do think that that's maybe Gurley's best point is like, how is it possible that we're still doing this model that made sense back in the 1960s? Computers have happened. We have an ability to actually select a price using the actual market matching mechanism. Like, why are we not doing this? It's nuts. And to me, the IPO, I think it's going to go the way of the dodo. I mean, I think it's going to be extraordinarily rare in 2 to 3 years to go to the classic IPO now that you can do the capital fundraise.
Yeah, but unless these first direct listings with capital sales suck, and if that happens, it could put a cap in it. But I don't think that's going to happen. But that's the only risk that I see. Now, we're going to move on to a couple of deals.